Hello and welcome to CIO Perspectives. I'm Sid Ahl, the Co-CIO of Private Clients, Endowments and Foundations here at Brown Advisory, and I'm joined today by Paul Chu. I call him our CIO with a capital C at Brown Advisory. He's been here since the beginnings of the firm, having started our equity research team and launched our endowment and foundation business, amongst other things. We're also welcoming Kif Hancock, our international CIO based out of our London office. Hopefully he can shed some light on what's going on outside the US, a topic which has quickly become much more on top of mind for investors. Today, we'll be discussing our recently released 2025 Asset Allocation Outlook piece and the whirlwind of news and market moves we've seen since the start of the year. As we wrote about in our Outlook, the initial market movements following US elections are often not sustained. Investors frequently jump to conclusions, and often they aren't the right ones. The initial response to the Republican red sweep in the US was quite favorable for markets and led to a continuation of a theme of American exceptionalism and US market leadership. US stocks outperformed, we had a stronger dollar, rising US interest rates, and the anticipation of stronger growth due to lower taxes and deregulation. But investors have pretty quickly changed their tune, as the first 2 months of the Trump presidency has been much more focused on tariffs and cost cutting than on deregulation and tax cuts. A quick editorial note, we're recording this on Thursday, the 13th, given all of the volatility in markets and policy. Wanted to timestamp this. With that, Paul, maybe I can start with you. The past couple of weeks, we've seen one of the more dramatic reversals of market leadership and sentiment in recent memory. This has been one of the fastest 10% declines in the S&P over the last 75 years. International stocks are outperforming, the dollar is weakening, US rates are falling, and the Magnificent Seven aren't looking so magnificent. They're down about 13% this year and leading the market lower. What do you see as the main drivers of this shift? And is this maybe a temporary shift or the start of a new regime?
Well, the latter part of that question is pretty hard to answer, and we'll try addressing that as we go through this conversation. Great to join you today, Sid and Kif, my friend over across the pond. As I think about it, there's really one word from my perspective that defines why the market has been doing what the market has done year to date, and it's uncertainty. There was this euphoric increase in equities post-election under this idea that we'd have deregulation and more focus on business, potential for a big, magnificent tax cut. But unfortunately, what the market has now started to wrestle with, and put it in the context of, we ended last year at very elevated levels of valuation for U.S. equities, driven in large part by some things we'll probably talk about later in this conversation around AI and really strong earnings growth. But the challenge has been, as we've hit into the on again, off again tariffs, it's really difficult if you're an individual, if you're a CEO of a large business, to really know exactly what direction we're going right now, particularly on trade policy, right? We've had Canada and Mexico being the first targets of tariffs. That original tariff might have lasted 6 hours, and then they've come back again. Now we had steel tariffs. We had a couple of hours of steel tariffs at 50% the other day, and that quickly reversed. And whether they're going to be effective or not from a policy standpoint isn't really the issue that's going on. Right now, the issue is investors do not like uncertainty. And that uncertainty is causing people to quickly reverse some of the positions and decisions that they've made in portfolios over the last couple of years. And that has led to, you mentioned the rapid decline in the Magnificent Seven. And I don't think any of them, maybe other than Tesla, is really having challenges to their business in a short period, any different than what they had 2 months ago. So why would investors be selling those? A lot because people made a ton of money in those stocks over the last couple of years. And so they garnered a huge portion of the market capitalization of the S&P 500. People are starting to sell them, and we've looked quickly to places that they haven't wanted to put. And so I feel like some days, Sid, I gotta be honest, I come in the market and I feel like as an investor, I get handed playbook A or playbook B, depending on market sentiment. And playbook A is we're going buy defensive stocks. We're seeing healthcare stocks and consumer staples go up and high value technology stocks going down. playbook B is we come in and inflation's not an issue, tariffs are pulled back, and all of a sudden we're going back to buying the Magnificent Seven, and the Nasdaq's going up and the other stocks are going down. So it's amazing how different it is on a day-to-day basis from that perspective.
Yeah, it really is. It's head spinning, chaotic levels of change. I think it's worth noting that we get asked often, how impactful might tariffs be? We're talking about what is being proposed, potentially unwinding like 80 years worth of globalization and taking tariff rates from 2 to 10 or 12% on goods coming into the US. So it's not immaterial, the debates that people are having about what the impact might be. And our economy is more service oriented and than goods oriented these days. But we're also, after 80 years of globalization, much more reliant on trade than we were back in the World War II timeframe.
Sid, the interesting thing is our current administration is very transactional in how they view things. When we hear 25% tariffs, that is the headline number. What will happen over the next couple of months, probably similar to what happened last time when he was the president, was we saw that company A would come and petition to the administration, and we would see XYZ industry excluded from the tariff or company. And so while the headline numbers are staggering and could be problematic if implemented the way they are today, it's back to this idea we're in totally uncharted territory from an uncertainty perspective. And the way I think about dealing with uncertainty from a market perspective is higher the uncertainty, the lower the multiple I want to pay for what's going on. And I think what we're seeing right now is not a reality, but the change in perception around what's happening out there in the marketplace.
I think it's a really good point. More uncertainty requires a lower multiple. And I think we'll talk about it a little bit later, but within tech, there has been a bit more uncertainty post the release of this Chinese model, DeepSeek, but even more recent announcements. Google came out just this week and said they've got a model that's pretty competitive that can run on one NVIDIA chip and is 90% more efficient than the competitors, as an example. So it has created some questions. And then I know we'll talk with Kif about just the policy differences between Europe and the US. They seem to be charting a slightly different path, more the path we were on of expanding deficits and government spending, while we're doing the opposite. But Paul, how does this policy uncertainty impact your outlook for economic growth in the US? Clearly, markets are pricing in the risk of recession. It is pretty likely that the first quarter GDP number is going to be negative just because of our trade balance, our ballooning trade deficit. So there's going to be headlines about that. How do you estimate the risk to growth in the US? And is it impacting what you're doing in portfolios?
Yeah, so it's a great question. And I think, Sid, I would start first with thinking about there's also one other part that we haven't talked about, which is the radical, quickly reducing government size with the DOGE initiative that's happening down there. And that is, you think about our economy, it's 2/3 consumer consumption, and the jobs picture in the States had been one of the things you would have said was the main positive economic force, was very healthy job market, low unemployment, decent wage growth. And you throw onto this uncertainty that's out there, the possibility of slowing government jobs, reduction of size. We've seen some companies start to reduce headcount related to use of technology and AI. That's a positive in some ways, but it's a negative on the long term. So it feels like we have a lot of confluence of things. And so the probability of recession has materially increased since the beginning of the year. I don't think we're probably over 50% right now, but the fact is market was pricing as if we were probably at 10% at the end of the year. So if we're in the 30, 40% probability, now what will tip us from being not in a recession to in a recession is the longer the uncertainty goes, the more it changes behavior, both at a corporate level and a consumer level. You hear it out of companies, but quite frankly, a lot of CEOs in the United States right now are afraid to actually say what they truly feel. So we have some talking about being a little more cautious. If history teaches us anything, during periods of uncertainty, management teams are going to hold off on that big capital investment project for a couple of months just to see what that is. And it becomes a self-fulfilling prophecy. We can talk ourselves in to a slowdown in economic activity as uncertainty remains incredibly high. So I think the longer the back and forth on trade war, on, off again, budget, the administration has a big goal of cutting taxes, which probably would be viewed favorably by the market, but deficit coming on the other side of it creates more uncertainty. So the longer it drags on, the more likely it is that we will hit into a recession from that standpoint.
Yeah, I think that's interesting. And we haven't heard any of the good parts, the pro-growth parts of the agenda yet. I mean, I guess we got a little bit of a vague announcement out of the EPA yesterday about rollbacks in regulations. Could be good from an economic perspective. I'm sure there are lots of views on where it might be not so good, but that could also tilt the scales perhaps. But totally agree with you on the uncertainty piece. It's also an issue with the consumer. I mean, if there's more job uncertainty for government employees and companies are cutting back on spending, maybe hiring, it could weaken the consumer outlook as well.
Yeah, Sid, I think it's interesting. If you take a look at aluminum, right, which is an area that they just put a large tariff on a couple of days ago. And the reality is we import, I think, 85% of our aluminum into the United States. And so if the goal is to produce more aluminum within the United States, it's not like you can wave a magic wand and have a new aluminum manufacturing plant in the US. It's going to take time to build that. Ironically, what do you need to build an aluminum manufacturing facility? Is a lot of steel, which, by the way, we also put tariffs on. So we're kind of a little bit counterproductive to put a tariff on steel at a time that you need to build more manufacturing capacity. So a lot of this is really about, if you're optimistic about what reshoring businesses to the United States are, those are further in the future. It takes time to build the manufacturing. It takes time to retrain employees. The reality in manufacturing in the United States, there's, from the last time I heard the number, 435,000 open positions for U.S. manufacturing companies. So we don't have the workforce trained for a lot of those jobs. So we can want to change a lot of these things, and we may all view those as long-term drivers of positive things for investing in U.S. equities. But the mismatch of timing, I think, is what's going to cause the short-term issues in the U.S.
Yeah, it's hard to make a 25 or 50-year capital investment decision in this level of uncertainty. Maybe good time to bring in Kif. I mean, we've been talking for a long time about the relatively weak economic growth, the poor labor force productivity numbers, the structurally higher energy costs in Europe as reasons for relatively pessimistic outlook economically there. Interestingly, we've seen a number of our managers, our stock pickers, buying European stocks the last year or so. And then year to date, we've seen European stocks leading performance, outperforming the US by 10 to 15%. Maybe you can shed some light on what's driving this.
Thanks, Sid. Maybe just to bring that first point you made to light, a statistic on sort of the structural headwinds to growth that Europe faces. And I think I shared this with you and Paul last week, that it's amazing to think that here in the United Kingdom, real median weekly wages in 2024 were lower than they were in 2008 and almost on par of where they were in 2004. Effectively, 20 years have passed and there's been no real wage growth in this country. And that really says something on a lot of levels. And it speaks to a lot of the structural weaknesses that you just highlighted that are sort of persistent, not only in the UK, but really across Europe. And before the recent US election, if we go back to September of 2024, Mario Draghi released a report to the European Commission in which he effectively addressed a lot of these structural issues. And he said, the issue that Europe faces is that for the past 15 to 20 years, it's taken weak productivity and economic growth as a bit of an inconvenience. And we now reach a stage where it's becoming more and more of an existential crisis. Now, I don't think he anticipated, the Trump victory and the ramifications of it. But as you rightly pointed out, since Trump has come into office, his language, policies, and directions toward the EU have really galvanized a lot of European policy leaders to really sort of take what has been perceived as inaction into effective action. And not only are they speaking more proactively on a consistent basis and having constructive dialogue, but you're already seeing countries take definitive steps towards doing more. And I think the most recent step with respect to Germany in potentially releasing some of their borrowing capacity to invest more in areas like defense is a positive sign across Europe. And I think that's one of the reasons you've seen European stocks in the near term begin to rebound, not just on I think, the defense angle, but really just the unification and movement angle. I mean, what you hear a lot of people say here is you may not necessarily get it right the first time, but the EU needs to just start doing something and recognizing some of these structural issues. And we see it here in the UK that the current government is actively trying to do more. And I think that's a real positive thing. And that's one of the things leading European stocks year to date. The other thing, and we've alluded to this, is they were just very, very cheap compared to the US. So to a degree, I think we're seeing some rebalancing in portfolios away from some of the tremendous performance the US has delivered over the past few years. And as investors try to strike more balance in portfolios, Europe is sort of a natural place to park some of that capital. So I think those are two reasons that have sort of led to the recent uptick in European equities. And I think the reasons to believe there are some pockets of constructive growth ahead. So we're kind of cautiously optimistic, and I stress cautiously, but we do have an eye on a few opportunities in the market today.
And the one thing, Kif, I would jump a little bit in on the idea you mentioned capital flow back towards international equities. Just to think, probably 10 years ago, you looked at an index like the MSCI All Country World Index, and it was probably made up 55% US and 45% outside the US. And I think we got close to 70-30 at the end of 24. So 70% of the world market capitalization being made up by the US. And it doesn't take a lot of capital flowing from the US towards Europe to make that a very good place to be investing. And, I'd say the one thing that's really changed in my 30 plus years investment career has been how quick capital flows around the world. When I first started, it would take weeks, months, years to see a transition from US to international, but we're doing it in hours and days today. And I think that as an asset allocator, that's one of our greatest challenges is how quickly things shift from one side to the next side.
Yeah, Paul, you're absolutely right on that. And I think that builds on a comment you made earlier in that things take time. Reshoring or onshoring back to the US, those things just take time because old habits die hard. And I think the point you're making is that capital moves much more quickly, sometimes than economic fundamentals. And that's something that is a challenge to us and something that we just need to be aware of. But actually, maybe shifting gears a little bit, Sid, coming back to you, I think in the Outlook piece we wrote about the four most dangerous words in investing is this time is different. And so maybe you could explain that part of our thinking and what it may mean in today's environment.
I think it's totally related to what we just talked about in an interesting way. I mean, it was Sir John Templeton who wrote in the days before the 87 market crash that the four most dangerous words in investing were this time it's different. There's a book written with a similar title after the 2008 crash by two Harvard economists. The idea is pretty simple. Once you start believing the historical rules don't apply, you're in a risky territory as an investor. So believing housing prices would never go down and you could package up a bunch of home loans led to the subprime crisis. Believing enough diversification would allow you to have unlimited leverage led to the fall of long-term capital management. The corollary today would be history suggests that when we have this level of market concentration in the top 10 stocks, we're at 100-year highs, and U.S. large cap valuations are in the 99th percentile. U.S. benchmarks, the S&P 500, should produce much lower future returns, and smaller companies and active management should outperform materially in the coming decade. International stock valuations are much cheaper, and the US dollar is in the 95th percentile of overvaluation versus other currencies. So that should bode well for international stocks. So for the US to keep outperforming the rest of the world, these huge companies to keep leading the pack the next decade, this time would have to be different. These big US tech companies, they make a pretty compelling argument for why it could be different. They have the best margin structure we've ever seen for these top 10 companies, 25% free cash flow margins. They're still growing earnings faster than the rest of the market. And after winning internet and e-commerce and digital advertising and cloud computing, Many of them appear to be poised to be the winners in the next big trend of AI. So typically some competition or regulation will upset the apple cart here, and investors, as you just mentioned, typically migrate towards cheaper valuations elsewhere. So what we posed in the outlook is it would have to be different to see this continued market leadership out of the US. So we're positioned to benefit from the Magnificent Seven or US large caps underperforming the rest of the market. We're overweight smaller companies. We have substantial exposure outside the US, but it's this balancing act to make sure that we still have exposure to some of these great large companies, many of which we still like at these valuations, which, by the way, are getting cheaper, Microsoft and Alphabet and Meta and NVIDIA and Broadcom. So I think the point there is we have to be considering some of these valuations on the equity and the currency side of things and the extremes that we got into when building portfolios to make sure we still have enough diversification for different market environments. And it could be the next decade is a decade of international outperformance. That's one of the scenarios we kind of have to think about. Kif, I mentioned earlier, some of our global managers have been leaning into European stocks despite the gloomy outlook, which you outlined. A lot of it has been pretty concentrated in a few industry areas. You mentioned a couple, but could you talk about some of the companies and industries where we've seen the most exposure built up and why?
It's a good point because sometimes narratives grow and broad-based narratives can be quite dangerous in the sense that Europe faces structural challenges, ergo, there's nowhere to invest in Europe, and that's just simply not the case. Our global equity team here and some of the managers that we partner with are picking really select spots in Europe where they see a lot of opportunity, and aerospace is a great example, whereby just the structural global demand for aerospace continues growing above GDP year over year, and that's really producing some excellent returns from some of the suppliers into that market. I mean, we tend to focus more on the tier 2 and tier 3 suppliers, those that supply the engines and the parts that go onto planes, but they've done exceptionally well for us. And names like Safran and Woodward and Melrose are names that consistently find their way into our portfolios and the portfolios of some of our most respected managers as perhaps low double-digit returns in an economy that's struggling to get a very low single-digit return. So that's one area. Infrastructure is another area that Europe is poised to do well in. I sort of joke that the developing world needs to build it. The developed world needs to replace it. And Europe is no exception. I mean, the demand for infrastructure in this market is very, very high. And getting back to the point you made earlier about fiscal budgets being stretched, this is one area where governments are turning more and more to private capital to fill the gap, to replace, upgrade, and expand a lot of those critical infrastructure assets. And last but not least, vertical market software. It's not lost on anyone that Europe and most of the developed and developing world, parts of the developing world, China in particular, face some material demographic headwinds going forward. And one of the solutions to that is more automation. And that's where software can play a very vital role. And what's interesting about European software is, if you're producing accounting software in Sweden, it doesn't necessarily translate into the same accounting software that's used in Spain, given jurisdictional differences, language differences, legal differences, whatever the case may be. So there's a really ripe, growing software market across the Europe that some of our partners are investing in quite aggressively. So there are pockets of growth, there are pockets of good value. You just got to be very selective in where you pick those spots. And Paul, with respect to non-US equities in your portfolio sitting in the US, what are your reaction to these recent moves? And in your view, are international equities cheap? Also, we think about currency pretty actively over here. Not to give you a three-part question, but a lot of times our U.S. colleagues only think about U.S. dollar-based assets, but when you're investing overseas, currency plays a significant role. So you've got this three-dimensional aspect to international investing, and really curious to get your thoughts on how you're thinking about it today.
Well, first I'd start with Sid used the word diversification earlier, and I think about investing in international. One of the bigger challenges for an asset allocator has been diversification. It's the worst thing I could have done to client portfolios over the last few years is to diversify them. But the reason we do is we can never predict when we're going to see reversals like we have. And if we're chasing those reversals, we're not going to do very well for our clients from that perspective. So we've always taken the stance of maintain your exposure, invest with people that you have high degree of confidence in, and let them do it for you. The reality was European stocks were really cheap on a relative basis to US equities. A lot of challenges. Clearly, you and I and Sid have talked about those over the years. But the reality was there was not a lot of capital flowing into Europe, low valuations, but none of us could ever predicted what was going to cause people to shift assets from the US to Europe. So I'm glad that I've had European equities, international equities in my client portfolios because I think that has benefited them through this period of time. They're not as cheap as they were, so it's probably harder from a valuation perspective just to say pile in, but I think we're only at the beginning of a little bit of sentiment shift. And if history tells us anything, those shifts can take years. We had one coming out of the tech bubble blowing up in the early 2000s where there was books and everything being written about the end of American exceptionalism. And look at what happened over the last decade. And so I think anytime you assume that it's going to continue from that perspective, you mentioned the dollar. I find that predicting currencies virtually impossible on a short-term basis, but there's times where they just get to crazy levels that we hit in the fourth quarter of 2024. Foreign currencies down 9% relative to the dollar and put them at multiple standard deviations away from normal. So I'm not predicting on a short-term basis, but I have the odds in my favor that the dollar was going to work in our favor as U.S. investors investing in foreign equities from that perspective. And those can be trends that take a long time and can be a tailwind to investing. So I continue to think I'm going to keep portfolios diversified. I'm going to continue to lean into managers. The great part is we have some great managers that invest in this space that have phenomenal returns here in a very short period of time. So I think it's an area I will continue to invest in.
Yeah, I think it's really interesting. The currency point, we really don't think and talk too much about it in the US. Outside of the US, in some places, it's the first thing that everybody thinks about and talks about. I was just in Latin America a couple of weeks ago, and that's the first thing they want to talk about is their currency versus the dollar. Putting it into some historical context, I think we have to remember there's a couple ways you can look at this, but on a purchasing power parity basis, the dollar is 25 to 75% overvalued versus the euro and the yen. So I think that's one of the things you kind of have to keep in mind if you have a 10-year outlook, is that could be a tailwind. And it's typically when the currency reverses that you also see the stock markets reverse and outperform. But Paul, you make a really great point on the manager side, especially we've transitioned to having more global manager allocations where they're picking stocks between the US and Europe. And I've been thinking about choice, say, between two companies doing very similar things like a Siemens Energy and a GE Vernova. Siemens Energy, they make gas turbines, wind turbines. They're in a good position to benefit from increasing investments to modernize the electrical grid in the US. It's a European company, but it's one that will benefit from all the rising electricity consumption tied to the growth in cloud and AI in the US. That's similar to this US listed business GE Vernova, but it trades at 40% discount on valuation. To your point, Paul, that valuation gap is closing, but it's still reasonably wide. And so if we can have global stock pickers who are finding those cheaper individual securities in one market versus another, that can take some of the pressure out of our hands to make that allocation.
I would add, I think you make a great point on those two companies because they're so similar. The other thing to take into consideration when you think about currency, it's almost the reverse effect. So if you have similar products and your currency has devalued significantly, you have a competitive price advantage over Siemens versus GE Vernova. They're going to be able to bid differently just given the currency movement. So while we spend a lot of time thinking about what the currency does to the stock price, there's the company fundamentals that the currency also influences. And when you get as overvalued in the US currency, that starts to hurt us competitively if you're a multinational company.
Staying outside the US, Kif, you spent a lot of time looking at Japan. We do have some dedicated Japanese exposure in portfolios, and that's something we've been talking about the last 12 months, increasing and leaning into. How do you see the opportunity in Japanese stocks today? How do you size it in portfolios?
Yeah, it's a great question. I mean, I can think back when we made our first on-the-ground due diligence trip to Japan. I think it was 2018. That was when I think the conversation around Abenomics and reform was really beginning to take shape. And what we heard on the ground there then was this is going to be a game of evolution, not revolution, meaning the Japanese go about this change in their own way. There will likely be a few sort of leaders that step out first and begin to implement some of the reforms around corporate governance, use of cash on balance sheets, margin expansion, M&A, things that are quite common with US equities and to a degree European equities. But we saw it on the fringes. And now, 6 years ahead, it's becoming more of the rule rather than the exception. And we're seeing it all the way across the public equity space. We're actually seeing a lot in the private equity space with some of our private equity partners. So it seems very constructive. And today, valuations still look fairly attractive. Balance sheets are cash rich, little to no debt, and a very supportive government helping a lot of these companies with these improvement stories. So that's all positive. And last but not least, one of the things that has struck me with respect to the Trump administration is for all of the rhetoric around tariffs with respect to China, the European Union, Canada, Mexico, we haven't heard much about Japan. And it seems to be one of the developed markets that has stayed out of the crosshairs, for lack of a better description, of the current administration with respect to trade rhetoric. And I'm not a geopolitical expert, but I do think the administration is thinking about their containment strategy, for lack of a better term, or how they're going to address the rise of China. And Japan is obviously going to be a significant ally in that effort. So it may be one reason they tend to be a little bit more calm with respect to Japan. But if you think about all of those aspects coming together, it seems to be a pretty constructive place to invest, and we continue to actively allocate. Now, with respect to your question on weighting at the moment, we're slightly overweight Japan. We're not trying to make a big bet. We don't think we need to, but we want to make sure we're not underweight Japan. And as you mentioned, we do those with managers on the ground where they typically speak the language, know the culture, know the history, and can really get an insider's perspective with some of the change that we see taking place.
Yeah, I think that's a really important point, that last one, because Japan has struggled so much as a marketplace that I think a lot of global managers just stop flying there. That's certainly what we see. And so if you want to have any exposure, you kind of have to be with specialists, and you have to, as an asset allocator, make that decision yourself. And definitely strikes me as a place where, given all the dynamics we just talked about valuations, currency valuations, and then all of these uncorrelated positive structural reforms that could take a pretty low return on equity market to a much higher one, you could see a multiple re-rating. It feels like the kind of thing that we'd like to have in portfolios, at least, as you say, equal to the global market. Maybe, Paul, we could go back to talk about US tech for a minute. We've spoken a lot about the impact of the release of DeepSeek, and I think you put this really well. It shook up the tech world. It was the first time we really saw maybe a bear case. What do you see as the actual impact of DeepSeek? And we've seen a big pullback in these AI-related stocks, the tech companies, the semiconductor stocks, the independent power producers. Are markets overreacting to this risk? Is there an opportunity developing here? What are your thoughts?
Yeah, it's interesting. We forget about what was the first moment of volatility this year. Actually, was the weekend when the Chinese company DeepSeek put out some information about their learning model, and it created an absolute chasm in some of the stocks. And not necessarily just the ones we all think about with NVIDIA and Microsoft. There was power producers that were down 30% in a day. And so just to kind of put a little bit of context to it, right? So the idea was that DeepSeek, this Chinese, actually, I think a tech company sort of sitting inside a hedge fund, had used some older NVIDIA chips and Lambda to basically map out a faster way of doing a large language model. And the easiest way somebody explained it to me was in the current language models that they're doing, whether it's OpenAI, Anthropic, and folks like that, it's like going to a library, and a librarian has read every single book inside the library when they ask you a question. In the case of what DeepSeek has had to do, because they haven't had access to the same processors that OpenAI and Anthropic have here in the States, is the librarian has read the specific section in which you're asking the specific question. So instead of reading every book every time to come up with an answer, it's narrowed down the framework on what they're doing. So they're able to process faster. They're able to do that with less power consumption. And that really spooked investors because there was this sentiment and belief system that the capital investment cycle that we had seen was going to continue for multiple years. And this was the first event that caused people to sit back and say, well, maybe when AI moves from just training the large language models and moves into more application usage, that maybe it isn't quite as capital intensive as we had run that out. And so I don't know if it derails the capital cycle that we've seen, but it's certainly put back to this uncertainty question. It gives you a little bit of pause that there actually is a scenario in which they're not building at the rate that we had seen it. You mentioned earlier with the large tech companies, this is different this time because of the cash flow generation, and it's not the same as the internet build out. So I do believe when we think about the use cases that we're hearing from companies, and some of the tech companies have been good early adopters of their own technology. A company, Workday, that we've invested in here at Brown, we use as a customer, has reduced their software engineer workforce because they've been utilizing AI as part of that. And so they're seeing the positive benefits of AI. So I'm a firm believer in the opportunity set within AI. We're probably, just like the build out in the internet, there's a transition phase. The initial is infrastructure. We then start to move into actual applications. And DeepSeek may have just accelerated the shift in investors' focus from pure infrastructure to more application on a go-forward basis. I'd love to hear from you, Sid, because you spend all day long talking to a lot of managers that invest in a lot of tech. So they had been very much in early in the investment cycle for the AI. Has DeepSeek caused them to change what they're doing?
It was really interesting. We talked to people the day after that weekend and then a week after, and it took people some time to formulate their thoughts. And I think there is a little bit more of a question, right? And things are changing really quickly. I mentioned Google coming out with their announcement even just this week. It's changing so fast. But what people seem to anchor to the most in the conversations I had was the explosion of usage. And that we can debate if it will be much cheaper. First of all, the cost of training these frontier models is going up. These clusters are enormous that they're standing up. There's definitely always been questions about, all right, when will we get to the end of that? It's as big as we can go to squeeze the last bits of efficiency out of training the models. But in terms of usage, I've heard people talk about looking at one data point on this is AI token usage, which gives you some sense of how much people are calling upon these models for answers. AI token usage last year was up 43 times. It's growing like 30% a month. So people are clearly using more and more of these models. And part of that is actually because of some of the things that DeepSeek revealed. The cost of running these models is coming down. It's down 95, 97%. So as it gets cheaper, people can experiment more with it, use it more, and there will be exploding demand potentially for usage. And you need the AI cloud infrastructure to do that. The question is, how much of that will you need? How big will usage get? I think that's an interesting debate, but certainly we've seen no near-term changes in the CapEx plans of the big hyperscalers. What we've heard is since DeepSeek, it's actually gotten like more expensive to rent or buy used GPUs, and all of the capacity that comes online for AI clusters is disappearing really quickly. So what I've heard generally is people going back to the fundamental use case and the usage exploding. And so actually looking at this as a bit more of an opportunity and looking at companies like a TSMC who has 90% plus market share in the manufacturing of these chips and saying, geez, the valuations come down quite a bit. Maybe I'll nibble a bit there. Maybe there's some discussion about market share between, say, an NVIDIA and a Broadcom and leaning more in the direction of a Broadcom. But I'd say net, we're seeing people leaning in. And I would make a broader comment, which is I think the whole active management universe as a whole appeared to be underweight this theme. So very few people were kind of overweight NVIDIA or overweight Broadcom versus what the market weights were. So I've also seen a bit, generalists have been trying to catch up in their research. And some of those generalists have been spending 2 years getting smart on AI, and they've been using this as an opportunity to add small positions into their portfolios. I think one of the most interesting debates is on the model companies themselves, where it seems so fiercely competitive, OpenAI versus Anthropic, and now DeepSeek and Alibaba and XAI. And with each new model release, one of these companies lurches just a little bit ahead of the competition on performance. So it feels like calling the winner in that space is a challenge. That being said, I've talked to a number of our managers who have placed their chips and are speaking with confidence about how OpenAI is the early mover and the clear winner in consumer for the models, and Anthropic appears to be the winner in the enterprise market. So, time will tell on that, but probably a little bit more fearful making a 10-year bet on who will be the winner in the model space. But if they are correct, these companies could have great returns from now going forward. Maybe, Paul, we could totally switch gears and go to the bond market. So from AI to the bond market, you've been a vocal advocate for building back up bond portfolios the last couple of years as rates have risen. I think this recent environment is a good example of why we did that. Maybe you could talk a little bit about how you're positioned within the fixed income part of your portfolios and if your outlook's changed with the recent fall in rates.
Yeah, it's a good question. So as we think about since 2009, post-Great Financial Crisis, until 18 months ago, I felt like the reality as a bond investor, we were trying to asset allocate with one arm tied behind our back, right? So you really couldn't get any yield out of your bond positions. And so it's just hard. To me, the easiest expected return for a bond is what the yield I'm paying when I buy the allocation. And we saw with inflation coming back and the Fed able to raise interest rates and get yield back in, a little bit painful process of doing that because you lose principal in your bond portfolio. But the reality is today, we're back to yields that are attractive from an asset allocation perspective. So if you can build out a core bond portfolio for a non-tax paying client in the mid fives and probably close to 4 in a municipal bond portfolio, those are reasonably competitive returns relative to expectations for equities with valuation this high. Now, there's been almost as much volatility in the bond market as there has been in the equity markets, maybe not quite as day-to-day dramatic, but we had the huge rise as Fed raised interest rates, market became concerned about growth in the summer and Fed starting to cut, and we saw a rally. And then literally the first day they cut rates, we saw a straight up movement back in the 10-year. And so we got close to 480 basis points on the 10-year Treasury. So for our clients, we've been moving durations out. Bonds, they play a really important asset allocation role, right? Diversification is one of the key hallmarks of why we have our bond allocations. When we get volatility like we've had the last couple of weeks in the equity market, bonds are up 2.5% this year, while equities are down 4 to 6. And so now that you have yield, you can actually get that defensive characteristic out of portfolios. Now, the yield keeps on moving around. So we've gone from 4.8 down to 4.2 here in the short term. So you've benefited from having that a little bit longer duration in portfolios. I continue to be a proponent that you want to have that bond allocation build out for that stability. The reality is if the equity volatility continues, one of the best things as an asset allocator is to have an asset that hasn't gone down as much, to be able to sell in market dislocations, to take advantage of sell-offs, and you can sell bonds and buy stocks. That works really well for you.
That's a really good point. How worried are you about the U.S. fiscal situation, and is it impacting your views? And then maybe I'll just lob on top of that, Fed independence, which we wrote about in the piece, and politicians trying to thumb the scale a little bit on interest rate policy. Do those factor in?
Yeah, they have to. So when we think about U.S. investment markets and everything that happens and is based upon this idea that the U.S. has been the reserve currency for the world for a long time. And that has allowed us to actually run incredibly high budget deficits and build up a lot of debt. without it costing us in the cost to borrow. So capital is very inexpensive inside the US relative to what you would look at our fiscal situation if we didn't have USA as our moniker and we looked at the same metrics for a country like Italy. The debt cost would be significantly higher than what we experience. And so the more that is challenged, and there could be reasons, it could be that we continue to blow out deficits and investors demand higher yields on that debt. It could be because one of the things on tariffs that I think doesn't get discussed, which is incredibly important. So if we run a budget deficit with Canada or China, that means that when they sell us goods, they take in dollars. And they hold those dollars. And historically, what they've done with the dollars that they've held is buy our debt. And so that keeps our interest rate environment lower and our cost of capital. And so if we run into a situation where we're no longer running budget deficits, they're going to have less inclination to buy US Treasuries. And that runs the risk that our cost of capital grows as our budget deficits are increasing. And so there is a scenario that we have to watch very closely that unravels some of the positives that we've seen over the years. The other thing I would throw out in this vein, Sid, a little bit is something Kif has been talking about recently, is that over the last 15, 16 years post-Great Financial Crisis, there has been, because interest rates have been driven so low, those with capital have significantly benefited, and those without capital have really struggled. And that has come in the form of lower borrowing costs. It's come in the form of higher stock prices. I think it's why we see this global populism push that we've seen across most economies, because while stock markets have done great, economies on the surface look like they've done great. Not everybody has done great because most people don't have capital. And those with capital, it's a beautiful world. Those without capital, it's been a more challenging world. That environment can't last forever. If you listen closely to the words, not coming from President Trump, but coming from people below him, they're starting to talk about this artificial inflation of money into the system. And if we start seeing them pulling that back, that probably has more implications than I think they would think from that perspective. So there is a scenario that keeps me awake at night, and that's really around, does the U.S. maintain American exceptionalism and reserve currency status? Because that's a game changer from an investment perspective. I'm not calling for that today, but I do have to have that scenario in the back of my head to watch. So, Sid, given everything that I just laid out about being concerned about the potential of the U.S. no longer being reserve currency, maybe you can talk a little bit about how hedge funds think about, because they tend to be a good place when you're worried about tail risks and that type of environment. So how are you thinking about allocating and investing in hedge funds today?
The first thing I would say is sometimes we go to the hedge funds because they tend to move a little bit more quickly. They're a little bit more reactive, and it's a good sense of where sentiment is. And I would say that sentiment has turned more negative in the hedge funds that we track. Now, a lot of the hedge funds we invest in are purely uncorrelated diversifiers. They're trying to make money in every market environment. And so our hope is that in a period like this, it's not having much of an impact. There are others, though, that will move their net exposure to the market up or down based on the opportunities that they're seeing or the risks that they're worried about. And we've definitely seen some of our managers and the industry as a whole bringing down their net exposure because of some of these concerns, the worsening outlook for growth in the US, the uncertain fiscal situation may factor into a few of those managers as well. And then even within the diversifiers bucket, these managers who try to hedge market risks and factor risks, when something like this happens, a really violent change in market leadership and what stocks have positive momentum versus negative momentum, all of these characteristics of companies gum up the models, the risk management models of these managers, and they tend to react to that by just reducing their overall risk. They have less confidence that the models are going to get it right, and so they reduce their risk. So I think that's been exacerbating a lot of these moves. is you have a company go from wildly positive momentum market leader to the exact opposite of that. And it makes people shift their exposure to that company just based on that. And sometimes we forget how much of the volume, trading volume in market is being dominated these days by these multi-managers like the Millenniums of the world and some quantitatively oriented managers who think way more than we do about these factors. Kif, to your point that you've made many times, hedge funds have been ignored to a certain extent as an asset class, but actually have been pretty valuable the last few years, particularly in years like 2022 when stocks and bonds were both down. And so what we've tried to do from an asset allocation standpoint is try to have more of our allocation to the space in these truly uncorrelated managers that are going to zig rather than zag when stocks or bonds are moving in either direction. And I think those managers are holding up well in a period of time like this. And even where we have some of the more concentrated stock pickers or credit selectors, we're looking for people who can add value on the short side of what they're doing and don't take on a ton of market risk. So that in a period of time like this, when markets are down 5-6%, we're expecting to do far better than that. And some of them will make money. I'd say the other thing that we have done in this space, which we talked about a little bit in our asset allocation outlook, is, we've started to use some of these strategies, hedge strategies that can translate passive into passive plus. So on the tax loss harvesting side, it's a tax loss harvesting strategy that adds a little bit of extra long and a little bit of extra short exposure to boost the tax benefit. It's also things like portable alpha and alpha extension strategies, particularly for non-taxable investors, where you're getting the index plus a little bit of long and a little bit of short exposure. So it's just a more capital efficient way to have an allocation to these uncorrelated strategies and portfolios. Paul, I'd kick it back to you and we could close it out. We haven't talked at all about private markets yet today. And I guess the good thing is when public markets are going down, your private market portfolio is going nowhere. You feel a little bit better about it. But we have seen a pretty big reset in private markets the last few years. How are you approaching building portfolios in the private world today? Do you feel like the scales are once again tipping back in our direction in the favor of investors?
I think they are, with one little caveat. I think the caveat is we have to change our mentality on timing just a little bit when we think about how long the duration that we're, particularly when we look at growth and venture side of private market investing. I think the opportunity set there is much better. We hear from funds every day that the size of fundraisers have been cut in half. Anytime there's less capital, that makes for a much more abundant opportunity set for return generation. But I do think we have to be, instead of thinking about 10 years, it's probably much longer than that, because companies can now stay private longer than they used to. So I continue to find the opportunity set much more attractive than it was a couple of years ago. You have to be judicious in areas. The private credit market has seen an incredible amount of capital flow in over the last few years, not always in lockup structures, a lot of more evergreen type where it gives investors some potential for liquidity. And if we do hit a tough economic patch, some of those may have a little bit more challenges, but I think there is plenty of places that look interesting from an investment perspective relative to a couple of years ago. So I continue to allocate client capital into that space, probably picking up a little bit over where we've been in the last few years.
It's really helpful. Yeah, it has been interesting to see as public markets have done so well. We have seen interest for private markets waning a bit, some questions about valuations, about distributions, but that has led to a pullback and a much tougher capital raising environment. And I think my instincts always as an investor, when everybody's starting to really pull back, that means it's probably getting more interesting, although acknowledging all of those issues that still persist, companies staying private longer in the private credit space, a lot of money being raised, and you really want to be with people who you are convinced are going to stay disciplined on price. And if they lose a deal because they're not willing to pay up. We want them to lose that deal because they're not willing to pay up. This has been great, guys. I really appreciate you joining here today. We welcome everyone to have a look at our Asset Allocation Outlook piece and give us a little bit of room, because obviously the world has been changing so much. So there's some things that we won't have been able to cover, but we welcome anybody reaching out if they want to hear more about our Asset Allocation Outlook. And thanks, Paul. Thanks, Kif.
Thanks, Sid. Enjoyed it. Kif, enjoyed.
Thank you.